Hey, everybody, and welcome back to our monthly market update. As always, I'm Brad Gotto, owner and founder of Fiat Wealth Management. And here with me, I have my good friend, Tim Holland, who is the Chief Investment Officer for the global Orion, but also more specifically for us here at Fiat. So, Tim, as always, thanks for joining us for our November monthly market update.
Yeah, no, it's good to be with you virtually. Always great to connect around the markets and the economy. So as always, thanks for having me on, and to anyone watching this, hope you're all doing well.
Yeah, I think you said virtually. Good to be with you virtually because you're assuming being in Minnesota in November is not a great time to be here. But as we record this, Tim, I think the high today is supposed to be 50 in November.
Man, that means you folks are wearing shorts and flip-flops and tank tops, right?
Well,
Hardy,
because we get to record this on Zoom, I don't have to show you that. So awesome. Did you have a good month, Tim? How are you?
Yeah, I'm doing well. Had a good Thanksgiving. Hope you did as well. It's nice when markets go up as opposed to going down. I know we're going to get into that. Family's good. We're in the 30s here in Pennsylvania. We got some snow yesterday and today, tiny bit, and so it's starting to look like and feel like Christmas. And I love Christmas, so I'm pretty excited. So I'm doing well. How about you?
You know what? I'm with you. I don't like cold at all. Everybody that knows me at all will tell you I hate cold. In fact, what you can't see below me is there's a space heater going on in my office, even though it's 72 degrees in here. So that's me. That said, I'm with you on snow for Christmas. It just doesn't quite feel like Christmas in Minnesota right now because it's 50 degrees. It's gonna be 50 degrees today.
Yeah.
So anyway, let's jump in here. So we stick to 3 key points on our monthly market update. And so point number 1 is going to be a look back over what happened over the last month. And the name of our point number 1 here is 9.1%. Oh my.
Yeah.
What in the world am I talking about here? I'm talking about the S&P. We had a good month in the month of November. That major index, which is the one that everybody loves to watch, was up 9.1%. Not the whole market was, but the S&P was. It was a good overall month. So Tim, what in the world happened? How did we had such a good month after such a bad 3-month run before that?
Yeah, no, August, September, and October were all in the red. We had talked about how we thought, or I thought, to throw myself under the bus and not you, that October would be a better month than it wasn't. It was down about 2% on the S&P. Yeah. And then you turn the calendar page and you get 9.1%, as you pointed out, Brad, which, if the S&P gives you about 9 to 10% in any given year on average, that's, it's pretty meaningful.
Yeah.
And bonds, the Bloomberg aggregate, sort of the S&P for fixed income, was up about 4.5%. So it was the best month for bonds in decades. So I think
so. It wasn't just the equity markets; it was debt markets as well.
Yeah, and debt markets has struggled. We talked a lot about the last couple of months with bond yields going up and up and up, and as yields go up, prices go down. So I think there were a couple positives. Earnings came in a bit better than expected. As we wound down Q3 earnings season, some of the economic data was okay, pretty balanced. But I think the big one was the October consumer price index print, the CPI print. As you know, it's been all about inflation and interest rates for the last couple years. And that CPI print came in cooler than expected, weaker than expected, which I think really reinforced the idea that after going through the summer where there were some concerns about inflation pressure maybe rebuilding or sort of remanifesting in sort of the economy, that cooler than expected CPI really drove home the point that, this inflation battle seems to be won. The Fed is done raising rates. And I think that dynamic, combined with a tough August, September, and October, people being very bearish, skittish, maybe moving away from the market and moving away from risk assets, you put those 2 things together, the market ripped, bond yields came in because the bond market was pricing in a more benign interest rate environment. And the yield on the 10-year note, which is probably the most important piece of financial paper in the world, went from 5.02% to about 4.10% as we sit here today and talk. So I think the big one was the CPI kind of giving us the all clear that, we're not all the way done, but we're just about done winning the fight against inflation, and markets were off to the races, which was really good to see.
So if I were to summarize that in, I guess, the most layman's terms I possibly can, Tim, it feels like the data, specifically as it relates to inflation, the markets feel like we turned a corner.
Yep.
and that the battle is being won, and that the forest fire that was inflation the last couple of years is at least under control. It's not out. The fire is still going, but it's been contained.
Yeah, it's a great way to explain
Fair?
it for sure. 100%.
Lovely. All right, point number 2 is our look ahead. And the name of this point is It's All About the Fed. It sounds like a weird rap song to me. But the Fed has a visit coming up on the 12th and 13th. And our look ahead, that's really where all the eyes are pointing, Tim. So tell us why that is where everybody is paying attention.
Yeah, and that ties back to sort of a look back, right? Better inflation data, the idea that the Fed's done, to your point, that forest fire, that raging sort of inflationary forest fire is pretty much under control. So the Fed meets the 12th and 13th, as you pointed out. It's a big deal. It's the last Fed meeting of the year. Most folks in our business are not expecting the Fed to raise rates, even though the Fed has been guiding to one more rate increase in 2023, another 25 basis points, sort of think of a quarter on a dollar, taking the Fed funds rate from 5.5% to 5.75%. The market,
which is their levels, right? So typically when they raise rates, that's like considered one level. So they don't mess around with like 10 basis points or 13. If they raise it, it's a quarter point at a time. And so that would be for them kind of one level, right?
Yep, for sure. Yep, quarter increments for sure. And so, but the market doesn't believe the Fed. We don't think the Fed's going to raise. So they'll meet. They should probably, come out of that meeting and say, we left things as they were, the Fed funds rate at 5.5%. But we get something out of that meeting, a meeting known as a summary of economic projections, also known as the dot plot, where the Fed essentially polls the members of the key Federal Reserve Committee around interest rates and asks them, what do you think the economy is going to do, inflation, interest rates, and the like. And so as inflation has come in and bond yields have come in, and there are some signs of economic softening, folks are going to be expecting that December dot plot to point to a more dovish monetary policy construct into 2024. The Fed being more explicit about when they're going to cut rates and probably letting the world know they're going to cut rates a little more meaningfully than they guided to in the most recent dot plot, and maybe a bit sooner. I think where there could be a little volatility around that meeting is maybe Wall Street's, gotten a little too excited that the Fed's going to come out and say, we really have whipped inflation and we're going to get ready to cut rates. I don't think the Fed will do that. They want to go cautious. They want to proceed in a cautious manner. But it's a big meeting. It's the Fed. It's the last one of the year. We think they'll stand pat. And we do think that dot plot will point to a more dovish, less stringent, less restrictive interest rate environment next year. And I think that's going to be well received on Wall Street.
So Tim, so out of all of that, just to be clear, the dot plot, this key piece of information that you're talking about and looking forward to can you summarize that again? That's them looking to who for that information?
Really looking at themselves. So let's pretend you and I are the two members of the Federal Reserve Open Market Committee. So it's known as the FOMC. The Fed's a massive institution, as we know. Lots of different committees, lots of different banks. But the FOMC is the entity that decides where interest rates should go, up or down, leave them alone. Super powerful, made up of different members of the broader Federal Reserve system. So if we were to assume that it's just you and I on that FOMC meeting, we would meet on the 12th and 13th and say, okay, the economy's slowing. Let's decide not to raise rates. Let's leave them unchanged. And then we would essentially fill out a survey. And you would be asked, Brad, and I would be asked, what do you think GDP growth will be in 2024? What do you think the unemployment rate will be? What do you think inflation will be? Where do you project interest rates going? So it's really a polling of the people that essentially determine where rates are going to go.
Yep.
Now, a lot of times it's funny, the Fed, as smart as those folks are, they get it so badly wrong, and at least they have. And I'm not sort of giving them a hard time. It's a hard thing to predict, a $28 trillion economy and inflation and interest rates. But if you go back a couple years, the Fed thought rates were going to be nowhere near where they ended 2022. They didn't see inflation being a problem. So a lot of times the dot plot doesn't sort of predict the future in any sort of accurate fashion, but it gives you a really good idea of what the members of that really important committee think the economy is going to look like, and where interest rate policy should go, if that makes sense.
It does. And so I'm going to summarize that point too before we go into point 3. And that is that not only are we going to get an answer of what they're going to do with interest rates in this visit, which is important to know, we're also going to get their gut feel of where they think the economy is going next year, which of course they can't predict the future any more than you and I can predict the future. But what it does tell us is their sentiment, which may help guide some of their decisions of where they're going to guide interest rates into the future. Because again, them setting interest rates or making the decision to raise interest rates or lower interest rates in this, or keep them the same in this visit, is based on kind of their gut of where they think things are going. And so now it's them kind of giving us their picture of where they think things are going, which then might in turn the market can kind of respond to a little bit and go, okay, they think the economy is going here, which means they should be doing this. They should be raising, they should be lowering, they should be, that kind of deal. So it does give us at least a picture.
And as we go through,
Fed sees things going.
I think that's a great way to explain it. And as we go through 2024, that dot plot will get updated essentially at every other Fed meeting. So like anyone else, they're going to take new information and sort of consider it and decide whether or not that changes their world view. But that's a really good way to think about the December meeting and the dot plot that we'll get.
Yeah, and for the viewers, if you're unfamiliar, the Fed every other visit, that means roughly about every 3 months, right? We get a new about once a quarter, we get a new dot plot. Awesome. Point number 3 is data. Just kind of an interesting piece of data that we've got going. So I'm naming this point, strength begets strength. And so what I'm referencing here is some benchmarks that the markets like to watch. Specifically, Tim, the 50-day kind of moving average of the markets and this 200-day moving average of the market. So tell us a little bit about what's been going on with these benchmarks and why we should care.
So most folks, when they think of the market, and think of investing, they think about putting their money to work based on what's known as fundamental analysis. What's the price of a stock? Is it expensive relative to how much money it's making? Is it attractively priced? How good is the underlying business? What are the fundamentals of that industry and sector? And then you build portfolios. You pick different stocks, you blend them into a portfolio, and you're off to the races. There are lots of folks on Wall Street that run a tremendous amount of money or manage a tremendous amount of capital using something known as technical analysis. So they look at market technicals or hard data as opposed to a company's fundamentals. And at the heart of technical analysis is the idea, at least one of the ideas, that strength begets strength or weakness begets weakness as it concerns the price of a stock. Meaning if a stock is going up, it's most likely going to continue to go up. If an index like the S&P is going down, it's most likely to continue to go down. And as these investors who run money that way monitor those stocks or their indices, they look for certain trends, certain price lines that Brad talked about, and whether or not the index is above it or below it. If it's above it, it's a sign of strength. And again, reaffirmation or an affirmation that index will likely continue to move higher. So as the market enjoyed this tremendous move up in November, that 9.1% run in the S&P that Brad talked about, the S&P 500 now sits well above its 50-day moving average and its 200-day moving average. And all we're doing with those moving averages is taking the price of the S&P 500 over the last 50 days or 200 days and plotting it in a line to get a sense of the trend of the index. So if the 50-day and the 200-day are moving up, it means the index has been moving up. If they're moving down, it means the index has been moving down. And because of the strength in the index, it's broken above the 50 and the 200. So for those folks that manage money, make decisions with their money around, again, technical analysis, price momentum in particular, that's a pretty meaningful development. And makes it much more likely that the index trades up to and through its 2023 high of 4,607. And I think as of today, we're only about 20 points, 25 points away from that. So it's from a technical perspective, it's a pretty meaningful development. Again, the idea that price momentum one way or the other tends to persist. So strength begets strength, as Brad explained it.
Yeah. Now, if you're listening to this and you're like me and you're not a data like nerd, there's
and
definitely,
hopefully you're not asleep. Hopefully,
yeah.
Well, if you are, you don't even know that I'm still rambling. So I guess that's okay. Sorry. Go ahead, Brad.
I'm going to be a broken record every single month and tell you this is why we do financial planning, because at the end of the day, you and I could, we could banter about this all day, every day. That doesn't mean we're going to be right. Right. It's analysis and it's data. You can glean a lot of information from data. But one of the things that I just want to point out here is, yes, it looks like the trend lines are great. Yeah. Right. Whether you're looking at a shorter term 50-day trend line or a longer 200-day trend line, there's a lot of people that look at that and go, hey, that's really good news for the future. Now, it doesn't mean into perpetuity, but at least for kind of the short-term future of our markets. Yeah. That being said, doing what's reasonable and doing what's rational are two completely different things. And on a spreadsheet, you can make the argument, Tim, that this is a pretty good time to be in equity markets. I mean, obviously last month was. The trends would tell you that coming to the future, if the Fed does what we think they're going to do, which you discussed in point number 2, and then these benchmarks, strength begetting strength, that we should have a pretty good run here into the near future. Yeah. That doing what's rational, which is spreadsheeting out what we just did, isn't always what's reasonable for somebody's set of circumstances or situations. And so just a fun fact here for you. If all of that sounds rational to you, but you're reasonably scared of the market still, it doesn't mean you should be in the markets. Because at the end of the day, the best diet anybody could go on that's listening to this is the one that you'll stick with. And if you can't stick in the markets to take advantage of some of this data, it's all meaningless anyway. The worst thing you could possibly do, and Warren Buffett would tell you this, is to get in and out of the markets. Yeah. The first thing to do is to get invested. The second most important thing to do is to stay invested. And so take that with a grain of salt. What's best for you is not what's best for your neighbor, and what's best for your neighbor is not what's best for your best friend. So, Tim, as always, super interesting. And this is our last one that we're recording for the year of 2023. I'm going to put you on the spot. Yeah. Next time we record, it's going to be 2024. Yep. I'm put you on the spot here. This is just friendly wager here. Virtual handshake. You and I are going to pick a number here. I didn't tell you I was going to do this because I didn't know I was going to do this. It's top of my mind. Okay. What is your number for the S&P in 2024? Up, down, or
year end?
Yes.
Year end?
Yeah.
Let's see. I'm going to go with.
I'm writing this down.
Fair amount of volatility because I think the market's going to weaken a little. I mean, the economy is going to weaken a little bit. Okay. We've talked about that. There could be some unpleasant headlines. But we're in a new bull market. Those tend to run for a long time. We've talked about that. Sentiment's still pretty supportive. I'm going to say if we're at 4,600 today, give or take, I'm going to say 5,000. The market never gives you 10%, but I'm going to say it's going to give you about 10%. It gives you 10% over time.
That is the S&P average. It just never does.
It's crazy, but it never gives you. So next year is the year when you actually get the 10.
I think 10% twice since 1950 or some crazy stat like that, it's actually giving you the average.
Yeah, I think that's right. So I'm going to go with 5.
You're going to go with 5. I made you answer first so that I could be more optimistic than you because I want to be an internal optimist. So I'm going to say 5,100.
Okay. It's like being on The Price is Right.
You always want to be the last one.
Been the guy who's like $1.
$1.
Yeah, I would have. And they always hate that guy, but I don't care. I would have just $1 for everything.
Every time.
Because I want to get up there with Bob Barker and, spin the wheel.
I'm with you. The Price is Right was fun when it was Bob Barker, not a Drew Carey guy. Different story, different day. That said, Tim, it's always a pleasure, sir. Thanks for joining us for the December monthly market update. And we will see you in 2024, sir.
Yeah, I look forward to it. Hope everyone has a wonderful holiday. And Brad, Merry Christmas to you and your family.
All right. Cheers. Cheers to all the listeners. Thanks for joining us again. We'll see you next month.
Bye.